Our revision will be on the 2018 paper. So since we're doing revisions, we'll select any questions where we feel we are behind. There are questions to do with ratio analysis, questions to do with CVP, questions to do with assumptions, and questions to do with ledger accounts. So maybe we can start briefly on question 2 and 3. So question number 3 is theoretical in nature. So we can quickly run through this one. Then we go to question number 4. So question number 3 reads, financial accounting has been described as a classification, recording of monetary transactions of an entity in accordance with established concepts, assumptions, principles, accounting standards, and legal requirements and their representation to users by means of income statements, balance sheets, cash flow during and at the end of the period. Explain the following terms and give 2 examples of each. What are assumptions? What are principles? What are accounting standards? Compare and contrast the trader entities and limited companies. So let's start with assumptions. What are assumptions? What are principles? Anyone to try that? Okay, quickly, without wasting time, we'll start with assumptions. So what are assumptions? Assumptions are simply fundamental concepts that underlie financial accounting. Okay, so when we're talking about financial accounting, we have what are called assumptions and principles. So by definition, we can simply define assumptions as follows. So assumptions are simply what? Accounting. Assumptions are simply basic ideas or beliefs that accounting is built on. So it's like a foundation of a building. So we have a number of assumptions. We have what we call the going concern assumption, which simply assumes that a business is assumed to have operating in a foreseeable future. So meaning a business is not expected to close anytime. For instance, a shop, they'll continue selling their goods next year, but will not shut down immediately. We also have what we call the accruals assumption, which simply assumes that what records of business transactions are recorded when they happen, not when money is received. So that is called the accruals assumption. So these assumptions are important. The accruals assumption, we can give an example. If you sell a good today on credit, you record it as a sale today, not because you received money today, but because transaction has happened now. We also have other types of assumptions, what we call the business entity assumption, which simply assumes that a business should be separate from the owner. We have also the consistency assumption, which simply assumes that we need to use the same methods every year. We have the prudence assumption, meaning we need to be careful. We don't need to overstate our profits. We have our materiality assumption, which simply means that only important items should matter. All right? The second question is asking to explain what principles are. What are principles, accounting principles? What are accounting principles? These theoretical parts are very important for our exam purposes. What are accounting principles? When we're dealing with accounting principles, we can define them as follows. Number one, accounting principles are simply rules that are used to apply these assumptions in practice. They guide us on how accounting is done. So these are called accounting what? Principles. They are rules that guide the accounting practice used on the assumptions. So can give 2 examples of what we call a cost um, principle and the revenue recognition principle. So the cost principle is simply a principle that assumes assets are recorded at their original purchase price, meaning you record what you paid, not the current price. So if the machine was 10,000 kwacha, you record it as 10,000 kwacha, even if the value now is more than that. We also have what we call the revenue recognition principle, which simply assumes that revenue should be recorded when it is earned, not when cash is received. Okay, the meaning here is simple. When it is earned, you record it. So for instance, if you sell goods on credit today, record it as revenue today. So we also have other principles, like the matching principle, which matches expenses with revenue, the full disclosure principle, which shows all important information that needs to be known for decision making. We have the objectivity principle, which says we need to use reliable evidence. So these principles, these are rules for applying accounting in real life. Okay, the next question is asking us to explain what accounting standards are. Who can explain what accounting standards are? So accounting standards, by definition, are authoritative rules issued by professional bodies like the International Accounting Standards Board. So accounting standards are official rules that are set by these bodies to ensure that all companies prepare accounting the same way. We have bodies like the IFRS 15, which looks at the revenue recognition. It explains how revenue should be recorded from contracts. So it records how and when to record sales. We also have the IFRS 16, which looks at leases. It explains how to record leased assets, how to treat them when they are rented as equipment. We also have other standards like IASA 1, which looks at the presentation of financial accounting, IAS 2 on inventory, IAS 16 on property and plant and equipment. So in short, the standards are official international accounting rules. Okay, our next question is asking us to explain, um, compare and contrast sole trader entities and limited companies. Okay, what with a sole trader? What features can you compare a sole trader and a limited company? 13 marks. So you cannot afford to miss those marks. So quickly, and compare and contrast. So you can compare them in terms of the features and the legal status, in terms of liability, in terms of ownership, management, capital raising, profit sharing, taxation, and continuity. So the differences could be number one, legal status. A sole trader is not separate from the owner, whereas a company is separate from the owner. So meaning a company as an independent person. In terms of liability, a sole trader has unlimited liability, meaning personal assets are at risk, whereas a company is limited. Only what is invested is lost. In terms of ownership, a sole trader is one person where a company has many shareholders. In terms of management, a sole trader runs everything, whereas a company has directors and people who manage the business. In terms of capital, a sole trader uses savings and loans, whereas a company sells shares. All right. So um, we also have profits. A sole trader will keep all the profits, whereas a company will share the profits as dividends. Then in terms of taxation, a sole trader um, pays income tax, whereas company pays two taxes, corporation tax and dividend tax. In terms of continuity, a sole trader, the company ends when the person dies, whereas the company, it never dies. In terms of regulation, a sole trader, it's a very simple. There are no strict rules or audits, whereas the company has strict rules and audits. Okay, that is how our question number one can be concluded. I hope that is clear. Then let's go to question number 4. Macoca registered a new company called Macoca Limited. Okay, and the company is operating on the 1st of January 2018. The following transactions took place. So we considering each of these transactions based on our duality concept. So we'll look at transaction number A, B, and C. We need to come up with a T account. So A simply says on January 1, the company commenced business with 150 in cash from Macoca as the only shareholder. So the duality concept says for every debit entry, or every transaction has two transactions. So when you start a business, we create capital. So we also have cash account. So you must also have at the back of your mind the principles that what you debit and credit must follow the rules of pairs. What do we debit? We debit all purchases have a debit balance, expenses to increase them, we debit them. All assets to increase them, we do what? We debit them. Then revenues or capital to increase them, we credit. Liabilities to increase them, we credit. And sales, increase them, we credit. Sales returns, it's opposite. To increase them, we debit. Okay? And purchases returns, to increase them, we debit. All creditors have a credit balance. All debtors have a debit balance, etc. So capital is a revenue here. So to increase it, we are going to debit. We are going to credit it. So started business. So say cash 150. Then here we're going to put capital 50,000. So why are we debiting capital? Because cash, why are we debiting cash? Because we're increasing our asset of cash. 2nd January, 145, cash was paid into business bank opened at Cairo. So now we're taking, so let me scrap off the zeros here so that we just move quickly. So 150,000. So we have this cash. So now of that amount, how much was taken into the bank? There's a counter entry within the same company. So from this amount, 145 was deposited into the bank. So we can say cash. The bank is receiving. So say cash here, 145. Okay. Then this one is giving out. So we read bank 145. Then January 6th, company bought motor vehicle on credit from Toyota for 330. So we have two accounts there. You need to identify the elements. We have a van that we are receiving, okay, and we have a creditor, which is Toyota Zambia. All creditors have a what? Credit balance. So Toyota definitely goes here. We say van, how much? 330. Then here we can say what? Toyota. So the title becomes the transaction inside here, 330. Okay. Are you following so far?
Yes.
Okay. So we go to the other transactions. We go to the other transactions here. So can somebody read the next transaction that we're having?
So D says the company rented shop premises for 15,000 per quarter
Okay.
and paid for the 6 months immediately by check.
So what is happening in that case?
There's an expense.
Yes. So there's an expense that is happening there. So how do you narrate that expense?
We debit it on the expense account.
Yes. So expenses have a debit balance. So what are the two elements that we're having there? We have what? Rented shop premises at this amount and paid 6 months immediately by check on 6th January. Okay. So we have two transactions. We have rent and what? And bank. Okay, so we're going to debit. So here's a bank. So 15,000 per quarter. So we paid for 6 months. How much did we pay in that case? Very important question. How much did we pay? 15,000. How many months are there in a quarter? A quarter is how many months?
3.
3 months.
Was
Okay,
it 3 or 4? 3.
3. Okay, so we're saying the company rented shop premises for 15,000 per quarter and paid for 6 months immediately by check. So meaning divided by 3 per month is how much? 5,000, right?
Yes.
Okay, so 5,000 was paid for 6 months. So when you multiply that one by 6 months, how much do we get?
The what? The 5,000? It.
Yes. Mm-hmm. 5,000 times 6 is how much?
30.
30, correct.
30,000.
So meaning we paid how much? 30 here. And then here we're going to say um, rent 30,000. You understand where 30 is coming from, right?
Yes.
So how much we actually paid was 30.
So I have a question now on this same
Mhm.
one. So we already had the bank account, the one
Mhm.
you opened, the
Yes.
previous one. So should we credit? We are crediting on that same one,
Yes, we're continuing on that
which has a
same.
145,000,
Exactly,
right?
yes.
Okay.
Yeah.
Okay.
We don't open another one. Yeah, you continue. Okay.
Okay.
So um a quarter is how many months?
3.
3 months, yes. Okay, so meaning we paid for how many quarters? 2 quarters. Okay.
2,
Yeah,
because they're saying 6 months.
yes. Okay, then the company bought goods on credit from Case Limited 144 on 10th January. So what transaction do we have?
Purchases account.
Shop expenses. Against what? bank. So you need to identify the two elements. Okay. So all expenses under payrolls have a debit balance. So here we're going to say what? Bank 115. Then shop expenses. Where are we crediting?
Are we on E or F?
We're on have we done this one? E. Okay, we'll get back to E. Let's do F, then we go back there. Paid shop
No,
expenses.
F we haven't done.
We haven't done E as well. So let's start with F, then go back to E.
Okay.
Paid shop expenses amounting to 115.
Okay.
Okay. So 11.5. Just removing three zeros. Okay, 11.5. So meaning we shop expenses, the expenses, to increase expenses, we debit them. Then the bank, because it's paying out, so it's reducing. That is how it comes. Then E, bought goods on credit from K's for 144,000. So what two elements are we identifying? When we say bought goods, what does it mean? Purchases, right? Purchases. And K is our what?
Yes.
Our creditor. So purchases, we put K here. How much? 144.
Editors.
144. Then here
144.
we go to purchases, 144. Okay. Then on 11, the company sold goods on credit to NAMS traders for 185. So who is NAMS? Is our data. All data have a debit balance. Then here we sold goods, sales have a credit balance, right? So here it's a NAMS, how much? 183. Then here we're debiting NAMS with sales of 183. It's actually 83, not 183. Okay. All right. So can you try the last two? Given you can pick E and I can pick J. Uh-huh. Right. So here we're going to have what? So on 24th January 2018, the company paid a check to K's Limited. So we already have K's Limited there. So we paid by check. So you're dealing with bank and you're reducing our Congole. So if we paid here K, since money is coming out of the bank, we are going to credit K with 1/3. Then to reduce, and Congole we have here, we will debit. So put bank here, 1/3. Okay. Then the 1st January 2018, total cash sales were amounted to 92,000. So you go cash and sales account. So cash sales. So I mean the cash, the sales is always receiving. So here put cash. How much? 92,000. Then you're receiving the cash sales, put sales there 92,000. So this is how our transactions will look like. Okay. This is how the transactions will look like. Then afterwards, you need to take them to a trial balance. Right together.
Yes.
Now we need to learn how to balance up those transactions. um, into the trial balance. So now let's go through the transactions that we had. Let's go through the transactions that we had. Quick, can you remember? Can we go through them again? So that we underscore the
Yes.
entries of the trial balance. So you take your time because this question usually comes and you have no option but to understand. So the transactions were as follows. Number one, we started business with what? Cash. Okay, so we debited 150 cash and we credited the capital account. Okay, so using pairs. So here our cash was what? Was debited and our capital was what? Credited. And the second transaction was we deposit cash into bank. So we transferred, debited what? The bank was receiving. Since the asset was increasing, then we did what? We credited the cash since cash was giving out. Then we buy a van from Toyota Zambia. So Toyota Zambia is our creditor. So creditors have a credit balance. Toyota Zambia. What did we do? Credited. And we also went to van since we're receiving it's an asset, we debited. Then paid rental for 6 months, 15,000 per quarter. So we divided 15,000 by 3, so meaning 5,000 per month. So 6 months, we paid a total of 30,000. So we go to the bank, since we're paying 1,000, we put here. And rent, we debited rent because it's an expense, right? So this is one. Then at the end of the month, January, our rent expense was what? 5,000. So for January, we didn't pay that, so it was owing. So what are we doing? We're going to debit the, so at the month end, January rent expense was what? 5,000. That was a prepayment. So we're going to uh, debit the rent account here and credit the prepaid rent. Then we bought goods on credit from K. So K is our what? Our creditor. So purchases we debit and we credit JKs. Then shop rent expense by check. So meaning we debit our shop expenses by 11,500 and credit bank. Sold goods on credit to NAMS. NAMS is our data. So we debit NAMS and we sales always have a credit balance. And again, we paid NAMS 180 by check from the same bank. So we are going to, so January 20, NAMS paid us 83 by check because he was owing us. So we're going to debit our bank both received 83. Then NAMS we're going to pay it because we're reducing his Nkongole. Then January 24, check paid to K is 180, 130. So we're paying the Ks. So meaning the bank is going to be credited because money is going out. Then we are debiting is limited. Then January 31, we have a cash sale, meaning there's no physical cash moving. It's called a contra entry. So meaning our cash sales, so meaning actually we received cash for our sales. So our sales figure, we credit, then our debit cash account because money was coming in. So if you're doing the key accounts, they'll look something like this here. So this is our what? Our cash account. For the cash transactions, capital is here. You get a mark for each entry. So cash sales were here. Then here bank we had paid from cash to bank. So what you do to balance up, firstly, you look at the side with the highest number. So in the total up here, we get 242. Okay, so 242, this amount was not there. So 242, so we subtract this amount from 242 so that the reducing balance 97, so that this part also balances. So we put 97 and 97. So this 97 will go into the trial balance as our debit balance on cash. So when you go to trial balance, we write cash 97,000 on the debit balance, the debit side. Okay, you go there. Then let's go to our capital. Capital only had one transaction. So capital, we started with business. Capital has a credit balance. Okay, so cash, we started with 150, but here there was nothing. So you give this side the balance credit down 150. So this 150 comes on the other side 150. So meaning our capital has a credit balance of 150 using payrolls. So when you go here, capital has what? 150. Then we go to bank. Bank, the number of transactions. So we had money is transferred from cash to bank 145, rent prepaid 30, NAM paid us then 83,000. So when you look at these transactions, you look at the side which has a bigger value. So in total up here, you get 228. And in total up here, you get 228 less 56. So you give this guy a 56 balance, which you take it on the right opposite. So the bank account has a debit balance of 56,500. Sometimes the bank may also have a credit balance when you have an overdraft. So with this amount, 56,500, you quickly take it to the trial balance here as a debit balance 53. Then we go to the van account. Okay, we bought a van. So we bought van by what? From Toyota Zambia on credit. So van is an asset we receive, whether it's cash, we are receiving it. So this amount here. So we go here, this side had nothing. We give this side the 330 so that it balances up. So this amount comes on the opposite direction as our van account. So van is an asset, 330. You put it here, you get your mark. Toyota Zambia, we got Toyota Zambia is our creditor. So Toyota Zambia, all creditors have a credit balance. So since we will go to write van here there's no amount there. So if it's on the credit side, our closing balance will be on the credit side. You just give this guy this figure, it will come here. So Toyota Zambia is our creditor. So we can write Toyota Zambia or creditors here. Okay. Then you do the same on the prepayment. By the prepayment, 25,000 expenses, rent, you balance them up. Our purchases, K is limited is our creditor. Our shop expenses are debited. NAMS was our data this side. Then our sales. So when you add up, the figures must total up here. 769 on the debit side and here this side. So meaning you would have balanced up your trial balance. So this is what makes your trial balance up. So you need to ensure that all the entries are correct. Okay. All the entries must be correct. Is that clear? So hence we answer our questions above, enter the appropriate ledger account, which you've done, balance of 5 marks, then post the trial balance. So we get out 25 marks there. So I'll ask you to do this question as your homework. You redo it.